You've probably seen the headlines by now. Another massive U.S. Treasury auction clears, yields spike, then settle. Commentators rush to declare either crisis averted or collapse imminent. And somewhere in the middle, the real question gets lost. Yes, the debt keeps clearing. But who's actually buying it, and what happens if the usual buyers don't show up the way they used to? Today, I want to slow this down, strip out the noise, and give you a clean, data-driven look at what's really happening beneath the surface. No doom, no cheerleading, just probabilities and positioning. Welcome back to Financial Briefing. Before we get into today's data, I want to start the way we always do here, with accountability. Earlier this year, we said that silver breaking above $28 would likely trigger volatility before any sustained trend, and that's exactly what we got. Spot pushed into the low 30s, pulled back hard, then rebuilt its base. Last fall, we said the 10-year yield would struggle to hold above 5% without a growth scare. It tagged 5 briefly, then rolled over. And in January, we flagged that Treasury auctions would continue to clear, but with weaker indirect bidder participation. That part also played out. Some calls work, some miss. But the point is to track the process, not chase narratives. So let's talk about the first data point that really matters right now, Treasury auction coverage ratios. Over the last 3 months, average bid to cover has stayed around 2.4. Historically, that's not alarming. Over the last decade, the average has been roughly 2.3. So on the surface, demand looks fine. What this means is that auctions are not failing. There is no immediate funding crisis. What it does not mean is that demand quality is strong. When you dig deeper, a growing share of that demand is coming from primary dealers, not long-term holders. Dealers are required to bid. They act as the buyer of last resort. So yes, the debt clears, but increasingly it's being warehoused rather than invested. The second data point is foreign participation. Indirect bidders, which include foreign central banks and large overseas institutions, have averaged about 62% of recent auctions. That's down from roughly 70% just 2 years ago. Historically, during periods of strong global confidence in U.S. assets, that number is closer to the upper 60s or low 70s. The context here matters. This doesn't mean foreigners are dumping treasuries en masse. Total foreign holdings are still above $7 trillion. What it means is marginal demand is softer. New issuance is increasingly absorbed domestically. And what it does not mean is an imminent dollar collapse. Foreign holders tend to move slowly, and reserves shift over years, not weeks. The third data point is issuance itself. Net Treasury issuance this year is tracking around $2 trillion. That's elevated by any historical standard outside of crisis periods. Pre-pandemic, net issuance averaged closer to $600 billion annually. The context is obvious: structural deficits, higher interest costs, and no political appetite for austerity. What it means is supply pressure is real and persistent. What it does not mean is that markets suddenly discover this problem tomorrow. This trajectory has been visible for years, and markets have been adjusting gradually. Now, if you're bullish on precious metals, especially silver, here's the strongest case for why this setup could matter. First, sustained high issuance paired with weaker foreign demand increases the odds of financial repression. Not tomorrow, but over time. That's supportive for real assets. Second, higher yields raise funding stress in parts of the system, which historically boosts safe haven demand. Third, silver has an industrial kicker. At around $32 spot, it's expensive relative to history, but demand from energy and electronics remains strong. And fourth, positioning is still far from euphoric. Futures open interest is elevated, but not extreme. Put all that together and there's a credible bullish path. Where silver grinds toward the mid-30s and holds, I'd assign that scenario about a 25% probability. But there's a solid bear case too, and it deserves just as much airtime. First, the U.S. is still clearing debt at scale without a buyer's strike. As long as that continues, crisis narratives stay premature. Second, higher yields actually compete with non-yielding assets. At 4.5%, real yields near zero, gold and silver lose some appeal. Third, industrial demand can slow if growth cools. A mild recession would hit silver harder than gold. And fourth, policy responses tend to kick the can. Any hint of fiscal restraint or growth surprise could pressure metals. And this overblown scenario, where nothing breaks and metals chop sideways or pull back, gets about a 35% probability for me. Which brings us to the middle case, and this is where I'm personally anchored. The most likely outcome is not collapse or boom, but strain without rupture. Auctions clear, but with increasing reliance on domestic balance sheets. Yields stay elevated, but capped. The dollar stays firm, but not dominant. In that world, silver doesn't explode higher, but it doesn't crash either. It trades in a volatile range, say 29 to 36, frustrating both bulls and bears. That's the slow burn scenario, and I give it about 40% probability. To understand why this feels familiar, it helps to look back at the late 1970s versus the early 2000s. In the 70s, deficits, inflation, and weak confidence drove metals parabolic. In the early 2000s, debt rose steadily, but credibility held longer. Today is closer to the latter. Similarity, rising debt, and geopolitical uncertainty. Difference, central banks have more tools, and inflation expectations are better anchored. History rhymes, but it doesn't repeat cleanly. Cross-market signals back this up. Gold at around 2,300 is firm but not euphoric. The dollar index hovering near 104 suggests resilience, not panic. And the 10-year yield around 4.25 tells you stress is present but contained. If gold were surging, the dollar collapsing, and yields spiking simultaneously, I'd be more concerned. That's not what we're seeing. Positioning adds another layer. COT data shows managed money net long silver, but well below 2020 extremes. Banks are net short, as usual, but not aggressively so. Institutional behavior looks cautious, not reckless. That supports the idea of a range-bound, volatile environment. So here's my personal action plan. If silver breaks above 36 on strong volume while yields fall, I add modestly. If silver drops below 28 with rising yields, I reduce exposure. Right now, my allocation is about 10% precious metals, split 7% silver, 3% gold. My stop loss on new silver positions sits around 27. My take profit on tactical trades is 38. Not advice, just my framework. What I'm not doing is panic buying on headlines. I'm not doom scrolling fear content. I'm not assuming collapse is a base case. Markets punish certainty. This week, I'm watching 3 things. First, the next 10-year auction. Strong indirect bids would be bearish metals, weak ones bullish. Second, DXY above 105 would pressure silver, below 102 would support it. Third, gold holding above 2200 keeps the floor intact. So to wrap this up, 1. US debt is clearing, but demand quality is shifting. 2. That creates long-term tailwinds for metals, not instant fireworks. 3. Silver's setup is constructive but volatile. 4. Patience beats prediction here. If this kind of calm, data-first analysis helps you think clearer, subscribe to Financial Briefing. I'll see you next time. Stay sharp.